Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to today's Cut to the Chase podcast. Today is Thursday the 20th of October. I'm Steve, and as I was going through the news overnight, I was reminded of the famous sketch from Friends. Ross, Rachel and Chandler are trying to get a sofa up a staircase, and Ross vociferously and repeatedly shouts at them to pivot around the staircase's U-turn. Why am I talking about this? Well, the Fed's Bullard gave the first indication overnight that he is thinking about pivoting sometime in early 2023. To be clear, pivoting did not mean reversing and cutting interest rates, only slowing or stopping the hiking cycle. To me, this makes total sense. While the Fed's assessment of current economic conditions, also known as the Beige Book, showed a slight improvement overnight, it was noted that businesses were increasingly pessimistic about the outlook, and there were signs in many districts that demand for workers, which has been very strong in recent times, was slowing. Separately, housing data this week has also shown weakness. On Tuesday, the NAHB Housing Market Index showed a greater than expected decline and is approaching COVID lows. And yesterday, we also saw a greater than expected decline in housing starts, which tracks the initiation of house construction and is seen as a good leading indicator of consumer demand. On the inflation side, the Beige Book highlighted the expectation for inflation to moderate, and this is in line with the recent IMF Global Financial Stability Report, which showed that market-implied probabilities of low inflation scenarios rose significantly in the past 6 months and is almost back to the levels that we saw at the end of 2020. So this suggests that the Fed's shock, awe and frighten strategy is working, and a pivot towards less aggressive policy tightening should not be far off. However, while another regional Fed president, Kashkari, also indicated that the Fed could pause rate hikes at some point in 2023, he emphasized that interest rates peaking at 4.5% would not be possible if core inflation continued to trend higher. If you remember, last week we saw core inflation hit a 40-year high in the latest release. Bond markets focused on the latter point, with yields going up across the curve. So the 10-year US government bond yield rose 12 to 13 basis points to a new cycle high and the highest since July 2008. The 2-year yield jumped by a similar amount to the highest level since August 2007. And so just to put this into context, the 2-year yield now has risen over 4% in just the past 12 months. So what does this mean for an investor? Well, obviously, overnight it meant further pain for investors as higher bond yields mean lower bond prices, and higher bond yields also put equities under a little bit of pressure as well. However, looking forward, it should enhance returns for investors, and the most direct transfer of this is obviously through the bond market. We have an end-of-year forecast of 4% for the US 10-year government bond yield versus 4.13% currently, and we expect to come even lower in 2023 as the economy heads into recession, forcing the Fed to back off from policy tightening and ultimately increasing pressure on it to ease policy. Therefore, we reiterate our view that bonds are looking attractive for both long-term investors and also for investors with a 6 to 12-month time horizon. For regular listeners, you will know that we prefer US dollar investment-grade bonds in this part of the economic cycle, both in developed markets and in Asia. Well, that's all for today, and Cut to the Chase will be taking its usual break tomorrow to make way for the CIO office's weekly Through the Noise podcast. Just to sign off, I wanted to wish Daniel all the luck in his attempt to regain the World Amateur Speed Chess crown in the coming days. And to all of our listeners, please take care and stay safe.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.